This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 8 of Value Investing. In this episode, I'm going to talk about a booklet that Warren Buffett issued in 1996. The title of the booklet is An Owner's Manual. He issued this booklet to Berkshire Hathaway's shareholders, and since then, he has included the manual in every single annual letter for Berkshire Hathaway shareholders to read. So it is very important for you to understand why he's doing that. The purpose of the manual was to explain Berkshire's broad economic principles of operation. Warren Buffett wanted new shareholders to understand how Warren Buffett is running his company because he thinks of his shareholders as partners and he wants them to understand Warren Buffett's principles. In this owner's manual, Warren Buffett lays out 15 principles that he sticks with in operating Berkshire Hathaway. I think it's important for us to understand every single principle that he lays out. So what I decided to do in this episode is to go over the first 7 principles in this manual. And in the subsequent episode, I'm going to go over the rest of 8 principles. So I'm so excited, so let's get started. The first principle says, quote, "Although our form is corporate, our attitude is partnership. Charlie Munger and I think of our shareholders as owner partners and of ourselves as managing partners. We do not view the company itself as ultimate owner of our business assets, but instead view the company as conduit through which our shareholders own the assets." This is the fundamental concept of value investing. What Warren Buffett is saying here is think of the stocks as part ownership of a company. Do not think of yourself as merely owning a piece of paper whose price wiggles every single day. Visualize yourself as a part owner of a business that you expect to stay with very, very long-term time horizon. This approach has a lot of benefits. If you're a long-term investor, then you will see that in the market, there are vast majority of investors who are short-term oriented and focusing on quarterly earnings and focusing on daily or weekly stock movements. You're going to set yourself apart from all this large group of people and you will have great opportunity to buy outstandings at bargain price. But this is easier said than done, even though you want to think of yourself as a long-term investor. What happens is that there are a lot of articles and news coming out in a negative way, then you kind of get influenced by these articles and news and you tend to sell your stocks. The same goes for buying a stock. So if there's a lot of positive news, you don't want to miss out great opportunity to make money and you jump on the bandwagon when the price is really high. So you need to have the right temperament in order to resist the herd mentality and become a true long-term investor. Buy stocks only when it is selling at bargain price. Second principle says, quote, "In line with Berkshire's owner orientation, most of our directors have a significant portion of their net worth invested in the company. We eat our own cooking." Here, I want to point out that Charlie's family has the majority of its net worth in Berkshire Hathaway. And also Warren Buffett has 98% of his net worth invested in Berkshire Hathaway. Charlie Munger and Warren Buffett are totally comfortable with this approach, eggs in one basket situation, because Berkshire Hathaway itself owns a wide variety of truly extraordinary businesses across different industries, ranging from insurance companies, utility companies, power companies, financial companies, and etc., etc. So what Warren Buffett cannot promise to you is the rate of return that he's going to deliver to you in the future. But what he can promise to you is that his fortunes will move in lockstep with your fortune if you were Berkshire Hathaway shareholders. He's not interested in gaining an edge over you, and there's no conflicts of interest between investors and Warren Buffett. Look at Warren Buffett's annual salary. It's only $100,000. And compared to all the other large financial institutions or large corporations in America, this is very, very small amount. It's only a small fraction of what other executives are getting paid. And also, Warren Buffett does not get stock options at the expense of shareholders. Stock options are not necessarily a bad thing for executives to be incentivized, but Warren Buffett thinks that this might be dangerous area where there might be some conflicts of interest, so he decided not to take any of this compensation. And also, he uses corporate jet out of his own pocket, and he doesn't do any fancy dinner, and he doesn't hire consultants for his acquisition activities. So there are a number of activities that he's doing right now that are in favor of shareholders. On the flip side, if you look at other large corporations, these are very common activities. I'm not saying that they are bad, but they may come at the expense of shareholders, so you may be wary of the executive who are spending a lot of money on these activities. Third principle says, quote, "Our long-term economic goal is to maximize Berkshire's average annual rate of gain in intrinsic business value on a per share basis. We do not measure the economic significance or performance of Berkshire by its size. We measure by per share progress." Warren Buffett here introduced the concept of intrinsic value per share. So what he's saying is here is that intrinsic value should be measured on a per share basis. The reason why it's important is because if you look at some large companies, they just go crazy to buy a lot of different companies at the expense of shareholders. It may be the conflicts of interest because in many cases, executives will benefit from these large acquisitions because the size of the company matters when it comes to deciding for their compensation. An overall size could be increased easily through M&A activities at the expense of shareholders. For example, the company can issue more stocks and dilute the shares of existing shareholders. Company can borrow money from financial institutions in order to secure the money for M&A activities. There are just so many ways that company can do in order to increase the size of the company. But this doesn't necessarily become beneficial for its existing shareholders. The only time it makes sense for a company to do this type of merger and acquisition activity is when the company is buying the other company at a price that is below intrinsic value. If you are an investor or shareholder of a company, you always have to watch out for such activities just to determine whether the management is acting in favor of its shareholders or they're just doing it for themselves. So in order to do that, you need to understand how this merger and acquisition activity happens. And whenever the management says synergy and whenever management pays a huge premium on top of the current stock price, or huge premium measured by price per earning ratio, then you really have to think about whether it makes sense from the perspective of shareholders. Fourth principle says, quote, "Our preference would be to reach our goal by directly owning a diverse group of businesses that generate cash and consistently earn above average returns on capital. Our second choice is to own parts of similar businesses attained primarily through purchases of marketable common stocks by our insurance subsidiaries. the price and availability of businesses, and the need for insurance capital determined at any given year's capital allocation. So here, Warren Buffett is talking about three things. First, he's talking about his preference to earn above average returns on capital. This is the situation that any executive is facing for their company whenever the company is generating a profits for its shareholders. So management can decide a couple of things here. Management can reinvest the capital profits back to the business in order to maintain the business or grow the business into different areas. Second, management team can distribute the profits back to shareholders in the form of dividends or share buybacks. And when it comes to making such decision, management has to think about what would be the returns on capital for the money invested back to the business. If management believes that the returns are not sufficient, then they have to distribute the profits back to shareholders. Second thing that Warren Buffett is talking about here is that buying the whole business is same as the buying the parts of businesses. Warren Buffett is saying that if opportunity arises, then he wouldn't mind to go to stock market and buy marketable securities for his company. So for example, Warren Buffett has acquired many shares of American Express, Wells Fargo, and these days he's buying a lot of shares of Apple. So as long as it makes sense for the company, as long as the company itself is large enough for Warren Buffett to make a dent on his portfolio, he wouldn't mind go to stock market and buy these marketable securities instead of buying the entire company. And the last thing that he mentioned is about his insurance capital requirement. So insurance companies are regulated by the government in an intensive way. So insurance company has to maintain certain capital level. So he has regulatory constraint here, which he has to follow. He cannot just use all of Berkshire Hathaway capital for merger and acquisition activities. The fifth principle says, quote, because of our two-pronged approach to business ownership, and because of the limitations of conventional accounting, consolidated reported earnings may reveal relatively little about our true economic performance. Charlie and I, both as owners and managers, virtually ignore such consolidated numbers. However, we will also report to you the earnings of each major business we control, numbers we consider of great importance. These figures, along with other information we will supply about the individual businesses, should generally aid you in making judgments about them. Warren Buffett here is talking about the accounting and the consolidated accounting numbers that he's reporting to his shareholders. What happens in the stock market is when a person first tries to analyze a Berkshire Hathaway earning, the first inkling that he's gonna have is to go to PE ratio and just try to see whether company is selling high or low price. This is a very simple ratio that you can use in many cases, but Warren Buffett thinks that these consolidated numbers do not make sense in the case of Berkshire Hathaway. Because Berkshire Hathaway has such a diversified group of businesses, it doesn't make sense to use consolidated number. Let me just give you an example. Warren Buffett has a lot of companies in the area of insurance business, and in the last episode, I talked about the importance of calculating float and combined ratio for insurance companies' valuation. And it doesn't make sense to combine the earnings, liability numbers, and asset numbers, and so on and so forth with retail companies that Warren Buffett has in his Berkshire Hathaway. Because what matters and what counts in the retail company is inventory management and profit margin and debt level. And it doesn't make sense to combine the debt from retail companies with the debt from insurance companies, because debt for insurance companies is called float, which is good when it's generating underwriting profit, whereas the debt from retail companies are probably from financial institutions. It is not good for shareholders. The sixth principle is called accounting consequences do not influence our operating or capital allocation decisions. When acquisition costs are similar, we much prefer to purchase $2 of earnings that is not reportable by us under standard accounting principles than to purchase $1 of earnings that is reportable. This is precisely the choice that often faces us, since entire businesses frequently sell for double the price of small portions. In aggregate and over time, we expect the unreported earnings to be fully reflected in our intrinsic business value through capital gains. Let me try to explain the message that Warren Buffett is trying to convey to its shareholders. So if you look at merger and acquisition activities for large corporations, in many cases, they do not serve as benefit for its shareholders, as I just mentioned a moment ago. The reason is that if you're an executive and your compensation is directly tied to earnings that the company is generating, it usually serves well for its shareholders. But when it comes to M&A activities, you want to buy the entire business instead of buying portion of businesses in the stock market if the only thing you care about is earnings. Then let me tell you why. Because if you buy the entire business, the business's earnings will be directly consolidated with your company's earning, and that's going to be good for your compensation. But if you buy marketable securities in the stock market, what happens is only the dividends distributed to your company will be reported as earning, and the profits that have been reinvested back to its business will not be reportable, and you're not going to be able to account that as your earnings. From the perspective of senior leaders, it may not be desirable to buy fraction of businesses in the market since it doesn't have direct impact on its earnings. However, Warren Buffett is saying that here that those earnings that are not reportable are equally beneficial to the company in the long term. So he doesn't care about these accounting rules, but what he cares is whether earnings make sense regardless of these are reportable or unreportable. Warren Buffett said, quote, "We have found over time that the undistributed earnings of our investees in aggregate have been fully as beneficial to Berkshire as if they had been distributed to us, and therefore had been included in the earnings we officially report. This pleasant result has occurred because most of our investees are engaged in truly outstanding businesses that can often employ incremental capital to great advantage, either by putting it to work in their businesses or by purchasing their shares." So this is what Warren Buffett called look-through earning. And I may have chance and opportunity to talk about look-through earning in the subsequent episode. As an investor, when you are trying to invest in a company in the stock market, in many cases, large companies have their subsidiaries, or large companies may have certain share of ownership of small companies. And if you only look at their consolidated earnings number, it may not be reflective of the entire true economic value of the company. The seventh principle is called, "We use debt sparingly. We will reject interesting opportunities rather than over-leverage our balance sheet. This conservatism has penalized our results, but it is the only behavior that leaves us comfortable, considering our fiduciary obligations to policyholders, lenders, and the many equity holders who have committed unusually large portion of their net worth to our care." This principle shows how Warren Buffett thinks about the debt and how he's using the debt for the company. When Warren Buffett previously met with MBA students, he criticized a lot of executives or a lot of money managers for their misusage of leverage. For example, he said, to make money they didn't have and didn't need, they risked what they did have and did need. That's just foolish. This is just plain foolish. Doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it doesn't make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed. If you hand me a gun with 1,000 chambers, 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up to your temple, how much do you want to be paid to pull it once? I'm not going to pull it. You can name any sum you want, but it doesn't do anything for me on the upside. But I think the downside is fairly clear. So I'm not interested in that kind of game, and yet people do it financially without thinking much about it. Warren Buffett is saying that it doesn't make sense to use leverage if you are risking the things that are important to you. The other point that I want to bring up here with respect to the leverage is the fact that Berkshire Hathaway has access to two low-cost sources of leverage. The first one is deferred taxes, and second one is the float. Deferred tax liabilities bear no interest, and it is good. Even though it's liability on the balance sheet, it is good because you don't have to pay interest. So this is better than the asset. You don't have to pay money and you get to use the money until a future date when you have to pay the tax. Another good source of leverage is float. I talked in a great length about the float, why it is good for Berkshire Hathaway in the last episode. So I'm not going to talk details here in this episode, but as long as the insurance companies generate underwriting profits, the cost of the float is free or even negative, which means you're getting paid in order to hold other people's money. Warren Buffett has been very smart in terms of using other people's money at very, very low cost. And this is free money. And also, this is the money that you don't have to worry about paying back anytime soon. Okay, so that's it for this episode. And as I mentioned at the beginning, I'll talk about in the next episode the rest of 8 principles in the owner's manual. And before I end, if you haven't already done so, please subscribe to my channel and I'll continue to talk about Warren Buffett and everything related to value investing on this podcast. Thanks again and have a nice day.